Hey you guys, my name's Jeff. Welcome to the channel. Today I want to show you 5 ETFs that are AI ETFs. These are ETFs that invest in artificial intelligence. So what I'm going to do is I'm going to show you the 5 ETFs that I have selected. 1, 2, 3, 4, 5. Each one of these represents a different ETF. What I'm going to do is once I get done with telling you guys about the 5th ETF, I'm actually going to share a bonus ETF that I just discovered yesterday. I think these are really cool. Just as a heads up before we begin, this is not financial advice. I'm not telling you that these make sense for you because I don't know your own investing goals, but I'm doing this just to teach you something so that you better understand how to invest in artificial intelligence. Now, the first ETF in our ring of AI ETFs is this one right here. And this blue segment represents VGT, which is the Vanguard Information Technology ETF. And VGT has a really low expense ratio of 0.10%. So this is a very low expense ratio. This means that out of every $100 you invest, you only pay a dime every year. And that's only $1 per thousand. And if you had $10,000, then you would just spend $10 for the whole year. And what I like about this particular ETF is 2 things. First, the return has been excellent. 18% over the past 1 year, which is a phenomenal return. And then if you go out over the last 5 years, we're talking a 130% return over 5 years. That is an excellent return. And so you're getting a very strong portfolio of all technology names. What you don't get in this particular ETF is Amazon or Google, because Vanguard classifies those as retail and communication stock. So this portfolio holds Apple as the number 1 holding, Microsoft as the number 2, and nvidia as the number 3 holding. You can see them right there. Apple is 24% of this portfolio, and then Microsoft is 19%, and nvidia is 6%. So, what you'll see is a lot of these AI ETFs are holding similar stocks, and they just change the percentage allocations in the portfolio. And in this video, I'm just going to be telling you about the top 3 holdings, except for a couple of these ETFs where I'll go into more depth. But I think it makes a lot of sense to pick the ETF that gives you the stocks you want and keeps the expenses as low as possible. So let's go over to the second segment. Isn't this satisfying? Now, some of you guys have probably heard about QQQ, and this is not an ETF that I discuss much on this channel because, well, I don't really have any real desire or need to invest only in high growth stocks. But this is the Invesco QQQ ETF, and the expense ratio for this is 0.20%. So what you'll notice is it's double the expenses that you pay for VGT, which is one of the reasons I've never really seen a reason to invest in this particular ETF. But the returns for this particular ETF are really good. They are 15% over the past 1 year, which is excellent. And then over the past 5 years, it has a And then over the past 5 years, it has a 107% return. So what you can see there is really high returns. And how does it achieve this? Well, if you look at the holdings for this particular ETF, we've got Microsoft in the position number 1 at 13%, Apple at 12%, nvidia at 7%, and then this ETF also holds Amazon and Google. And those were not in the first ETF we discussed, VGT. And that is because Vanguard classifies Amazon as a consumer discretionary or a retail stock, and it considers Google to be a communication stock. And so they put those in other ETFs. So their Vanguard Information Technology ETF only has Apple and Microsoft and nvidia and other technology stocks, but they don't have Amazon or Google. So if you want those, this ETF would make more sense. I personally don't invest in this one, but I see nothing wrong with it. The only thing I don't like is that the expenses are a little bit higher, but still at 0.20%, it's still a pretty cheap ETF compared to some of the other options we're going to be looking at. Okay, so now we are moving over to this green one. And do you know what this green one represents? The green one represents the Round Hill Ball Metaverse ETF. This invests in some of the other stocks that the other ETFs I've talked about invest in, but it invests in a few others, okay? So let's just take a look at MTV, okay? First off, the big difference here is that this one has a 0.59% expense ratio. So this is a lot more expensive than the other ETFs I've talked about. And you might want to ask yourself, well, why is it so much more expensive? And the simple answer is, this is a slight digression, but all ETF companies and all mutual fund companies and pretty much all financial services companies exist to make money off of you. So they market different funds and they say, hey, check this out. This is a really cool ETF. Why don't you buy shares in it? And then they make money out of your assets that are in that fund. And they make money whether the market's going up or the market's going down. So that's a really good business to be in. Vanguard is the one exception. They're actually not a for-profit company. Vanguard is owned by their shareholders. They don't have publicly traded stock, and they don't have people that they have to show profits to every quarter. And that's one of the reasons Vanguard can keep their expenses so low and pass the savings on to you in terms of very low expense ratios. But when you're looking at Round Hill Ball Metaverse ETF, well, they're charging 0.59, and that's kind of expensive. That's why I particularly wouldn't invest in this, but I think it makes sense to take a look at. And I know if I say I wouldn't invest in it, that might, sour you to it, but take a look because this might be of interest to you. Okay, so in addition to that 0.59 expense ratio, it's gotten 11%. It has an 11% return over the past 1 year. All right, perfectly acceptable return. But then when you look over at the first two ETFs we talked about, VGT has returned 18% and it charges less. And then QQQ has returned 15% and it also charges less. So when you look at this, they've done a great job branding this METV for the metaverse, but they're also charging a lot of money, and it is questionable whether you're actually getting value in return for that higher price you're paying. And by the way, let me just run through some of the holdings. And fun fact, METV used to be called Meta. So that was a really cool ETF name, META. But when Facebook changed their ticker symbol and their name to Meta, then this ETF probably got paid to sell them the name, and that way Facebook could get META as their ticker, and METV is the Metaverse ETF. The top holding is nvidia at 10%, Apple at 8%, Roblox comes in at 7%, Metaverse, or rather Meta is 7%, Facebook Meta, Microsoft at 4%, Google at 4%, Amazon at 4%. So what you're getting, Sony at 3%, Tencent at 3%, and Qualcomm at 3%. So what you're getting here is a mixture of all of these stocks. Most, if not all of them, are already in the S&P 500 ETF. And what you're getting is a high expense, and their 1 year return is 11%. So You should know about this because all of these companies are somehow involved in AI. But again, the 1-year return is 11%. And with VGT, you're getting 18%. And QQQ, you're getting 15% return for the last year. And of course, these numbers aren't going to repeat themselves in the future, but you should know that this is an expensive ETF that doesn't have phenomenal 1-year return. And there are no returns for the 5-year period because this ETF has not been around for 5 years. It's kind of like a new kid on the block, whereas the first two I talked about have been around, both of them, for more than 5 years. You guys, we're almost finished. Let's see. We have done this one, and we did this one. We just did this one, and now we are on to the orange segment of our beautiful ring of colors, our artificial intelligence ETF ring. And the orange one represents number 4, BOTZ. BOTZ, you gotta love that, right? Like bots, like robots. So what BOTZ has done is they have created an AI type of ETF. The full name of this ETF is the Global X Robotics and Artificial Intelligence ETF. So they're obviously trying to take advantage of all the excitement about AI and robotics. So BOTZ charges 0.69 for the expenses, and you know how that translates is 69 cents out of each $100 you invest, $6.90 out of every 1,000, and $69 out of every 10,000 invested in this ETF. So when you look at it this way, you know, compare it to VGT, the Vanguard Information Technology. They charge you $10 for every 10,000 invested. QQQ, the Invesco ETF, charges you $20 per 10,000, and this one here charges you $69 per $10,000 invested. So that's a pretty expensive ETF in my opinion. Now their returns are 18% over the past 1 year, which is excellent. Okay, that's really good. It's the same as the VGT ETF, although you pay a lot more in expenses for that return. But then if you look back over 5 years, you'll find something that was just stunning, which is their 5-year return is also 18%. And that to me is a really low return. Compare this, for example, to the Vanguard S&P 500 ETF, because that one has returned over the same period of time 56%. So you're getting 18% in this artificial intelligence ETF, and you could have gotten 56% in VOO over the last 5 years. So, you know, if any time is a time where AI should be soaring and doing really well, I would think the 5-year returns for this particular ETF would be a lot better than the Vanguard S&P 500. But there you go, 18% 5-year returns. And you know, also this compares to VGT, which is the Vanguard one, 130%, and QQQ 107% over 5 years. And then we're looking here at 18%. To me, BOTZ is not worth the high price of admission. All right, well, you know what that means. All right, well, we have arrived now at this one, number 5. The number 5 ETF, AI-oriented ETF on our list is none other than, drum roll please, that's what you say when you need a few seconds to get stuff together, IWYW, and that's the iShares Dow Jones Technology Sector ETF. And I really like this one, except its expenses a little bit high for my liking. IWYW, there it is right there. And the expenses for this one are 0.39%. And now you're getting the hang of this. That means if you were to have $1,000 invested, you'd be paying $3.90. And if you had $10,000 in that, you'd be paying $39 every year. So these are ongoing expenses. I don't think $39 would be a lot of money to pay if this were the best option available. This one here is a 19% one-year return. I'm just going to show you 1 year, 19%. That's darn good. That's the best one on our list so far. And 138% return over 5 years. 138. No, that's not right. That's not right. Okay, people, you've made it to number 5, and here we are. IYW, and that is the iShares Dow Jones Technology Select ETF, represented by the light blue. And what we're going to do is take our pen, which is light blue, and we are going to write IYW, and we'll put down 0.39%, which is the expense ratio. All right, so now you know that means you're paying 39 cents for $100, $3.90 for $1,000, and 39 bucks for $10,000 invested. And that's every year. So keep in mind these expenses, they stick with you even when the stock market goes down. You're paying these companies just to hold your money in these ETFs. So IYW has a 19% 1 year return, which is phenomenal. That is a super return. And over 5 years, 130%. So I automatically put this up near the top of my list because the expenses are not too high. They're not in the 0.6 or the 0.5. You're at 0.39, but the returns are excellent. And so this ETF, IYW, rounds out the 5th ETF in our survey. So just to kind of review these, we started out over here with VGT, and then we went over to QQQ, we looked at METV, then we looked at BOTZ, and then finally we just checked out IYW. So I promised you guys that I would share a bonus ETF if you stuck around until the end. And I am the kind of guy who makes good on my promises. And I really like this ETF. And like I mentioned, I just discovered this ETF yesterday. XLK is the Technology Select Spider ETF. And this one charges a really low 0.10%, which I love. This is the same expense ratio as VGT, which is the Vanguard Information Technology, the first one we talked about. I think for these ETFs, the expenses should be lower. Now, I haven't been mentioning all of the holdings of each of the ETFs in this, but I will say for this last one, it also holds Microsoft as its top holding at 25%, Apple at 23%, and nvidia at 6%. So it's holding the same 3 top holdings of that Vanguard Information Technology, only the order's a little swapped. This one holds more Microsoft, and then it has Apple, and then nvidia, and the VGT was Apple first, and then Microsoft, and then nvidia. So you're kind of buying the same basket of stocks, but the order's a little bit changed. So 25% in Microsoft, 23% Apple, 6% nvidia. The returns on this have been phenomenal. In fact, 19% for 1 year, 19% for 1 year, which I believe is the highest return of anything on this list so far, and 138% for the 5-year period. So what you're seeing here is that the returns on this particular ETF are greater than any others on this list, and the cost is the same as the Vanguard ETF. So I think that's a pretty good bonus. What do you think? I like this XLK because I think, you know, if you can get the stocks you want, that the same stocks that are in some other ETF, but you can get them at 0.10%, which is what that is. Just put a little point on it. There you go. There, 0.10. That's really cheap, and that's a great way to hold on to stocks like Microsoft and Apple and nvidia and all the others in this ETF. And yeah, I think if you can do this, you got to figure you're going to be holding these ETFs for at least a year, right? 2 years. I hold them for 5 years, 10 years, 20 years. I mean, I'll hold them for a long time. And so that means every year I'm paying money to the ETF provider. So I just want every year for that amount that they get to keep to be lower. Yeah, that's just facts, okay? So quick recap, we're talking VGT was number 1, QQQ was number 2, METV number 3, BOTZ number 4, and IWYW was number 5 with the bonus of XLK. So that's all your info for today. I hope that you found this to be useful. If you have any questions or comments, put them in the comment section below. Also, if there are any ETFs that invest in the AI space that I haven't discussed but that you're interested in or that maybe you invest in, please write them in the comment section. That way other people who watch this video will learn about them so we can all get a little bit smarter. And yeah, that's it. If you like this video, please give it a thumbs up. That way the YouTube algorithm will know to recommend this to other investors, other people like you who might find the info in this video to be useful. So thank you so much for watching, and most important, make it a great day.